Hello and welcome to Financial Intelligence. In this video, I want to talk about the impact of inflation on stocks. Since most people are worried about inflation these days, a common question is how investors should allocate their assets during inflationary times. It is important to note that not everyone is concerned about inflation. To provide a balanced view, I have decided to share the perspectives of Warren Buffett, who is concerned about inflation, and contrast it with the perspective of Cathie Wood of ARK who thinks inflation is not an imminent threat to the US economy. In the first part of this video, I'm going to share with you the data that shows various types of stocks respond differently to inflation. Therefore, depending on your expectation about inflation, you can focus on subcategories of stocks which tend to perform better during higher inflation periods versus the ones that offer better returns during lower inflation periods. In the second and third part of this video, I'm going to share with you how Warren Buffett and Cathie Wood have positioned their portfolios according to their contrasting inflation expectation. If you like the type of content that I provide on this channel, subscribe to this channel and give this video a thumbs up, and also hit the notification bell so that you won't miss any of my future videos. Part 1. Impact of inflation on stock returns. Numerous studies have looked at the impact of inflation on stock returns at the aggregate level. Unfortunately, these studies have produced conflicting results. That is because high inflation can have mixed effects on the economy. High inflation can help the economy as it can stimulate some job growth. On the other hand, high inflation can also impact corporate profits through higher input costs. Therefore, when analyzing the performance of S&P 500, taking into account the impact of inflation, the results are mixed. However, the analysis gets more interesting when we start looking at the subcategories of stocks rather than the aggregate S&P 500. One way of unpacking this data is to break the stock population down into value and growth subcategories. Simply put, growth stocks are companies with fast-growing earnings and revenues. On the other hand, value stocks are companies that are considered bargains because they are trading at low prices relative to earnings or low price to earnings ratios. Historical data shows that value stocks perform better in high inflation and growth stocks perform better during low inflation. That is because value stocks usually have strong cash flows that will slow over time, while growth stocks have little or no cash flow today but are expected to gradually increase over time. When inflation pushes labor and commodity prices higher, growth stocks get into trouble because of their weak cash flows. In contrast, value stocks can weather the storm more confidently because of their strong cash flows. Another reason is that when inflation is low, growth companies can borrow money cheaply and invest in their business and disrupt larger, more established companies. However, when inflation is high, the cost of borrowing money is too high and prevents growth companies from taking on larger value companies. Part 2. Warren Buffett and value stocks. Warren Buffett is known for his value investing approach all his life. As he has expressed concern about inflation, he is doubling down on his approach to prepare his portfolio for a higher inflationary environment. At Berkshire's annual shareholder meeting, He commented that, and I quote, "We are seeing very substantial inflation. It's very interesting. We are raising prices, people are raising prices to us, and it is being accepted." As mentioned before, value stocks tend to outperform other companies during inflationary times. One of the reasons is that in an inflationary environment, money now is worth more than money further down the line. Since value stocks are usually found among larger, more established companies with strong cash flows, they are considered short duration assets. This means that value stocks enable investors to recoup their money sooner rather than later. Since Warren Buffett considers inflation as an emergent threat, he has focused his portfolio more on value stocks with strong cash flows. Part 3. Cathie Wood and growth stocks. Cathie Wood is the founder and CEO of ARK Invest. Her flagship ARK Innovation Fund has returned an average of nearly 40% annually over the past 5 years. Cathie Wood believes that innovation-based deflation will help keep rising costs at bay in the long term. She considers the recent rise in inflation temporary, and she does not seem to be worried about a sustained inflationary environment. She has also discussed how she believes the bull market has more room to run. Based on this hypothesis, she is fully invested in growth stocks. Growth stocks are considered long duration assets, which means that investors have to wait longer to recoup their money. That is because growth stocks usually refrain from paying out dividends and will instead reinvest retained earnings back into the company to expand. In the absence of significant inflation, growth stocks can deliver higher returns than value stocks. Since Cathie Wood does not consider inflation as an imminent threat, she has positioned her portfolio to include various growth stocks. I hope that you liked this video. If you have any recommendation or suggestion, please add them in the comment section below. Don't forget to subscribe, like this video, and hit the notification bell so that you won't miss any of my future videos. Thank you and take care.